What are the best investments you think right now in the AI age?
In the AI age, so the first, like the basic thing that everyone needs to start with is to have discipline and save every single month. Um, the saving has to come before the spending. So if your salary hits your account on the 5th of the month, your autopay should pick up your savings on the 6th or the 7th of the month so that you don't have a chance to spend it. And that's a non negotiable. It doesn't have to be 50% of your salary. Just the habit of taking money and putting some aside every month, that's the first like starting point. The second point is, what do you do with this money? Where do you put this money? I would first start with having an emergency fund. I think like a large percentage of Americans today cannot deal with even $1,000 unexpected expense, which is crazy to me because the same people might be spending $50 every week at the pub, or the same people might be spending on mobile games. Of course, there's a lot of people genuine issues which doesn't allow them to save, but I think most people could put aside 1 hour of their salary every week, and if you make $25 an hour, you can put $25 aside. Next question is, what do you invest in after the emergency fund, where you have maybe like a month's worth of savings at the very least. I would not try to beat the market. I would not try to research stocks and all of that. I would rather just put the money in an ETF, in a broad equity or debt ETF, where there's a fund manager doing all the stock picking for me. And you might say that, oh, this year the AI stocks went up 60% and I missed the boom. But if you're investing month on month, every month, and discipline and in a large basket of stocks, you're going to get phenomenal returns over the long term. The equity markets have never failed to give huge returns over a long term. If you hold it for a month, then you may even lose 10% or 20%. But in a bad time like a global recession, but the people who have held on and just kept putting in money at every price, those are the ones who have done really well. Because for you to get to a point where you're smarter than a fund manager, it's going to take a lot of time and resources, which you may or may not have. And it's a distraction from what you are good at and what will get you, more salary, more income. The ratio between equity and debt depends how much risk you can take. Younger people can take more risk because they have more of a earning lifetime left. So the common ratio is 100 minus your age. So I'm almost 40, so I can put 60% of my funds in equities. Now I'm a more informed investor, so I may take more risk. I might do something on the option side. I might dabble in other forms of investment. But that whole adage that the real estate is your main purchase, it doesn't hold true anymore in my opinion, because A, it is so expensive to get in, and B, um, it's so expensive to maintain, and given the interest rates and given all the costs associated with it, most people don't get there till very late in their life. But if you want real estate exposure, there is a real estate ETF you can buy. So put 10% of your money in that instead. um, so I would just keep it simple and not overcomplicate, not try to be get rich quick about it. The disciplined savings over like 10, 20, 30 years is what will really give you the peace of mind.